Okay, here's a second video. Where you sort of this is an example of opportunity cost. And I said here earlier on, opportunity cost is the value of the best alternative forgone when you choose a certain option. So the issue here really, if we bring it back to business, I mean, I used an example of an NPV scenario. Oops, sorry. I used an example of an NPV calculation. But the same idea applies to a machine. But if you have a machine doing something, and then you stop doing that something to do something else. So that something else, of course, there's a cost to doing it. So, for example, this might be a new contract that might come in and you stop doing what you ordinarily doing. Well, as soon as you start doing this thing, yes, of course, there's a cost involved here, but also as well, you're missing out on the potential revenue this should have been doing. So this revenue lost out on is a potential cost, and opportunity cost, as you should consider that as well. And this is what, so whether or not, the irony here is, even if you didn't have a new project, if you just had a machine doing something, well, the next best thing that could have been done with that machine would have been to sell it. So every time you're using a machine to do something, I mean, the reason why we use a machine to do something is because it's bringing us more in, it's bringing more in than us potentially selling it, right? Otherwise we would sell it. You know, you would just do, if a machine's only going to bring you £3,000 and you can sell it for 10, why would you use the machine to make that product? Unless there's another sense of value, or a value of nostalgia or something that you can't quite measure per se. But otherwise, you would sell it and get £10,000 in. So this is a nice little example. You bought this machine for £20,000. So example, you bought this a long time ago, so this is a sunk cost. It has no bearing on what we do in the future. The current net book value, this is an accounting figure, 20,000 minus 15,000 of depreciation, of accumulated depreciation, if you like. Now remember that we don't really care. What does this even mean, accumulated? This is our estimation or guesstimation of how much it has fallen by over the period. So another accounting figure, really. And then we have the sales, which is, now this is a potential cash flow, and this is the relevant figure here that we need to be looking at. So a project comes along, and the question is, what is the opportunity cost if we choose to carry out the project? Well, if we carry out the project, we lose out on being able to sell our machine. So that product better bring us in more than 4,000. Otherwise, it's better off to just sell the machine and then forget about it. Okay, great. So that's the opportunity cost. And I put out here, you lose out on selling the machine. Again, I highlight the fact that we're only focusing on cash positions. This is another example of opportunity cost. So let's go through it quickly. So we have a company that manufactures and sells one single product, and this business is currently operating at 85% of full capacity. So it has 15% capacity to make stuff. Great. It has 15% capacity to make things. And it's currently producing 102,000 units per month. So here it says the current total monthly costs of production amount to 330,000, of which 75,000 are fixed. So if 75,000 are fixed, we know that therefore 330. You'll probably see this on a slide, but I'm usually too impatient to wait in the next slide. Just to give you the thinking about it, if that's the total cost and that's the fixed cost, well, the variable costs must be the 330. I'm just doing it on that calculator. Minus 75. Must be 255,000. But we already know from the previous slide that we're dealing with 102,000 units. So the variable cost for 100 is for 102,000 units. So in effect, you can almost work out straight away what the variable cost is on each unit. And if you know what the selling price is on each, you need to know what the contribution. So that's kind of the thinking you have when you're given this sort of total cost and you're given the variable, so a fixed cost. Your aim is, I need to find out what variable cost is. You sort of know the variable cost is the same thing as marginal cost here. In our debates, we never argue that marginal costs increase. We just argue that they stay the same. If you like, remember this sort of straight line curve. These are your units and that's your cost. So that's your general sort of way of starting to think about what's happening here. So we can work out what the variable cost is per unit by dividing the 255,000 by 102. So if you divide this by this, you will get £2.50. So we know that it costs this business right now £2.50 to make each unit. So with that in mind, knowing that the marginal cost or the variable cost is £2.50, it says that this new guy comes along and has expressed interest in taking a regular monthly delivery of 12,000 units at a price of £2.80. So he's offering you £2.80. So that's 30p more than this £2.50. Okay, but you currently sell each at £3.25 per unit. So you're currently making £3.25 minus £2.50 per unit. Currently making 65p on every unit. Yes, that's what you're currently doing. So that's great. Currently making 65p on every unit, but now someone's offering you 30p. I mean, the argument here is you do have spare capacity, and it is greater than your variable cost. Now remember, we can only talk like this because we're way into our production process and we have covered our fixed costs. I mean, I'm going to argue we have. I'm just arguing that we have. We probably have. I mean, we could work it out. If you like, we can work out break even. So you can just see the thinking behind this one. Okay. In addition to this, you have a little caveat. It says that if the new business is accepted, existing sales are expected to fall by 2 units for every 15 units. So for some reason, whether it is you're going to be taking someone away, a main person from the current production, existing sales will fall by 2 units for every 15 units sold to the customer. So we can work out what that is, because for every 15, I mean, you're going to make a 12,000 delivery. So for every 15 of this, you're going to fall by 2. So you're pretty much kind of, question is, how much do you fall by? Which would be 12, right? Because for every 15 of this 12, you're going to fall by 2. So we can know that we're going to fall by a total of 12,000 divided by 15 times 2, just because we take on this, we take on this 12,000 divided by 15 times 2. So that's 1,600. We know we're going to fall by 1,600 units on our current existing production if we take this on. Okay, let's carry on. So the question asks, what is the overall increase in monthly profit as a result of accepting this new business? So, I mean, I think it's just good to work out what the additional, if you could make the capacity. I think it's just good to work out, okay, what's our total capacity? We can make 120,000 units. We're currently making 102. That means we have capacity for an additional 18,000 units. You're only making 12. So yeah, you have capacity. So you can even think about this thing. A question might create a scenario where you don't have enough capacity, so you can only offer up to the point because you can't make more than the number of men or machines, availability of those resources. So this is just pretty much doing what I've done earlier on. We have 330,000. I took away the 75. I left that. 2,000 units. And we're using this. Therefore, each unit is £2.50 per unit. I know the new customer is offering £2.80, giving a contribution of 30p. Current contribution, I calculated 65. I think it must have been 75. Forgive me. 3.25 times £2.50 gives us 75p. So again, like I said, the scenario was we gain, the situation is that for every 15 units we lose 2 units, so we gain, so here we are, so we lose 2 units meaning that when you have 30p here, of course, which is what you're gaining on every 15 units. They're sort of broken it down interestingly, but it's the same thing. 30p for 15 units, you're gaining £4.50, and for every 15 units, you're losing 2, and therefore you're losing a contribution of 75p times 2, which is £1.50. So overall, you have a gain of £3, if you like, on every 15 units. Because you would have gained £4.50, but you're not. You're only going to get £3 because you're losing £1.50 as a result of the fall in the production of the existing units. So the overall gain must be the 12,000, which is what the contract is for, divided by 15 times this gain of £3, and that leaves you at 2,400. So you can see we had to consider this opportunity cost, so to speak, the type of opportunity cost that they give us. Okay, great stuff. I'll end the video there because I want to try and keep it on 10 minutes, and then we'll move. I'll just quickly do this slide very quickly. So just some key points. Depreciation is a non-relevant item. Profit or loss. Remember, all these profit or loss arguments are very much an income statement argument. The original purchase of the machine is a sunk cost. And NBV, again, like I said, net book value, and these are just accounting values. Yeah. Okay, great stuff. I will see you in the next video.